Welcome to Stocks in Translation. I'm Jared Blickery. Next to me is Sydney Freed. You know her well. First, be sure to like, subscribe, comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming in Brett Kenwell. He is a U.S. investment analyst at eToro. Hello, guys. Today, we're going to be getting back to fundamentals, Vince Lombardi style, because stocks still trade off earnings. Our phrase of the day is sentiment. It's kind of what you think, but since it's finance, we quantify it. And this episode is brought to you by the number 245 billion. That is the notional amount of Tesla options in dollar terms that traded the Friday after the election, how to leverage the power of options in your favor. So, Brett, why don't we begin here by you just breaking down what you see happening in the market since the election? It's been a wild ride.
Sure. Yeah, it has been a totally wild ride in the last couple of weeks, but really this whole year has been it's been great for bulls, but it hasn't been an easy ride. I think sometimes the hardest trade is to just stay long when the tailwinds are in your favor. But, even just working through the headlines of this year, it was in Q1, we had, worries of reflation and whether the Fed might have to raise rates again at some point. In the summer, we had a lot of volatility with, the Japanese carry trade unwinding, with the change in presidential candidates. We had a lot of bumpiness. We had worries about the jobs market. And then we had to get through the election and seasonality issues. And so all these kind of situations come up and you start to wonder, should I be out of stocks? The market's been on a good run. Do I, take some out, move to cash, move it to gold? There's so many things did so well this year. You get this kind of nervousness, I think, about equities at times. But it's been a great year and we got through the election. I think for a big part of market participants, a big part for investors was actually just getting through the election. I think there was this worry that the market, we weren't going to know who won the election for maybe days, maybe weeks. The fact that we knew pretty much right away, like one day later, I think was kind of a sigh of relief for investors. And you saw that with the S&P, you saw that with the Russell, with Bitcoin. I mean, all these things just sort of resolved to the upside. And for a few days, we chopped around nicely and consolidated those gains. And last week was a little more rough. We had a little bit of a pullback, but I think that's a good thing. We can't go straight up, especially we're up more than 20% on the year. It's nice to pump the brakes a little bit and let things reset.
You're talking about all this craziness, but honestly, for most investors, this should just all be noise, right? You shouldn't be making so many moves just because there's an election every 4 years, right?
Sure. No, going into the election, I think the markets actually handled it really well. I remember having a few conversations early in the year. We were looking at how well the market had done in Q1 and rallied about 10%, the S&P that is. And there was this thought that, hey, it's an election year. Should we be a little more
circumspect?
Yeah. Should we not be so optimistic? And all through the year, you just kind of saw the market in a way shrug its shoulders about, that's an election. Okay, that's fine. And the outcome is that's kind of how it handled it after the election too. So I think I wouldn't really change my perspective on my investments because of the election or going into it or coming out of it. I would stick to the fundamentals personally.
Wise words there. And it kind of leads into our word of the day, which is sentiment, which is in finance pretty close to the common definition. So market sentiment, whether it's bullish or bearish, is the current attitude of investors overall regarding a company, a sector, or in the financial markets as a whole, like an index. It can be measured by various technical indicators. So how do you think of sentiment?
Yeah, sentiment's an interesting one. Now anymore, when I look at sentiment, you can use, there's various measures online. What
do you use first? Because there's a lot.
Yeah, there's the AAII measure.
That's a survey that takes investors what they think of the market. Is it bullish or bearish? And then they aggregate that. So that's the AAII.
Yeah, there's the AAII. They do that every Thursday. You could even do something as simple as the Fear and Greed Index.
Yes.
Which is which measures by the daily, on a daily basis. And so, but sentiment now I feel like changes so quickly. Nothing, I don't know who said it, but nothing changes sentiment like price. And if things can feel like the world's ending and the market pops back to life, and all of a sudden everyone feels okay and sentiment's okay, and vice versa. We could be at all-time highs like we were a few days ago, few down days, and you go on Twitter and you think that we are on the brink of financial Armageddon. So sentiment changes really quickly. Investors, you mentioned noise earlier. I think they just have to be careful about letting too much noise in. They have to be really guarded with they filter information and how they let that impact their decision making.
Yeah, I was gonna say, so to me, sentiment seems maybe like a day trader thing, someone who is making decisions on the regular. Again, to a long-term trader, I feel like you shouldn't really be like, oh, this has been a tough 6 months. Like if you're just investing in a bunch of ETFs, like keep the money there, right?
Yeah, exactly. And another thing, when sentiment is really low in the garbage, maybe that's an opportunity to start thinking, you know what, maybe I'm going to go against the grain a little bit. I want to fight the tide and maybe, step into equities. If we're 10 or 15% off the highs, the market has been a compounding machine over the long term. And, some of those best opportunities to get into it is when the sentiment is at its worst.
Buy the dip.
Exactly.
What are you bullish about right now?
What do you like?
I think when I look at the market, we were just having this meeting with our global analyst team a couple days ago, and we're getting ready to do our 2025 outlook. And so we're sort of playing with how we want to approach the new year. And the takeaway has sort of been cautiously optimistic. We had a 2023 year where the S&P finished up 24%, but it felt sort of like it was a very disliked bull market because for the first 3 quarters, it was
very concentrated.
Yeah, it was the Magnificent Seven, and I always call it the Magnificent Eight, throw in Eli Lilly in there. But, they did all the heavy lifting for 3 quarters of the year, and people really doubted that bull market, this bull market. And, in 2024, we've just seen a continuation of that or continuation of the gains. It's much more broad participation now. We have many sectors participating in the rally. I believe 9 out of 11 are up 13 or 14% on the year. So it's been very strong, very nice rally. It's hard. I can't expect to be up another 20% plus like we have the last 2 years, but I think a gain in 2025 is reasonable.
I was wondering, I'm seeing more attention being drawn. Okay, we have 2 years that are probably going to be back-to-back 20%, unless the rug is pulled, the last few weeks of the year, which could happen, but we haven't seen this since the late 90s. So this brings up the obvious comparison of the dot-com boom and subsequent bust. How are you thinking about this?
I try to be careful with comparing really anything back to the 2000s. It was just such a unique period of time of such a speculative bubble type of mania on a huge scale. We do obviously see periods of rampant speculation and a lot of, we do see bubble-like tendencies. A few years ago really comes to mind, with GameStop and that whole sort of stretch. But, for now, I obviously we can get back to that place. We don't want to get back to that place. But for now, I think we're still in a steady as it goes type of situation.
So here's a question from our producer. Can there be too much sentiment in one direction? And what I'm thinking is, well, this can be a contrary indicator. And I've used this. We talked about the AAII bull bear survey. When that gets too stretched into fear territory or greed territory, you can fade that. How do you think about that?
Yeah, I have a hard time, I guess, getting bearish because sentiment is very high. But at the same time, I do think that can be a time for people to maybe pause, especially if you're an active investor, sort of tap the brakes. And this really does boil down to how active are you? Are you someone who's trading every day or every week? Or are you someone who's a little bit more just putting money away every paycheck? If you're putting money away every paycheck, you probably shouldn't really worry that much about sentiment. Maybe in those scenarios, use it to your advantage when sentiment's really low because it would tend to come with a big market correction. And, there's a good opportunity there, most likely when you look over the long period of time. But if you are more active, then yeah, you can use sentiment in both directions. If it gets a little overheated, might be time to take some chips off the table and, rotate into something else or into cash and wait for an opportunity.
Right. This is based in absolutely no math, but pure vibes.
I love it.
My sentiment, I feel like I'm witnessing a stock market that is just hitting new all-time highs all the time, and it seems people are pretty bullish. But that makes me feel a little bit like, isn't it going to all come crashing down soon? We talked a bit about bubble complacency. Like, I guess, how do you balance that risk with, are things just going to be good this whole time? What should I do with my portfolio to hedge against the potential that it's not going to be great?
Sure. Who was on here recently? I think it might have been Tom Bruni being on the vibe check. Yeah. It runs on vibes sometimes. And that's the case with the overall market as well at times. And you're right. I mean, when things get overheated, when everyone feels like it can't get better than this, that's usually the time where the music stops and you have to scramble for a chair, right? for me, I try to keep things as simple as I can when I do my work, and I look at the big drivers of the market, which should be earnings growth, the Fed, and the economy. And right now we have all three of those things working in the bulls' favor. Double-digit earnings growth for the S&P is expected through 2025. The Fed is dovish, whether they cut rates in December, whether they kick that can down into Q1. We don't necessarily know, but they're moving in the right direction, the direction that the market wants it to move. And then finally, the economy continues to chug along. We have low, single-digit growth. It's steady. We have unemployment's, low by historical standards. So we have things kind of working in the bigger picture, working in the bulls' favor. If one of those were to change, that's where I would start to change my tune.
It took about 10 minutes to mention the Fed. Do you think the Fed is overplayed here just in terms of people paying too much attention to it?
Man, we have so much focus on the Fed, and every report that comes out, it's what is this doing to the rate odds? And
what does Jerome Powell think about this? It's not what happened, it's what does Jay Powell think about it?
What does Jerome Powell think about it? What color tie is he going to wear at the press conference?
It's usually purple. We know this. Slightly askew.
Yeah, I think generally speaking, we're moving in the direction that we want the economy to move in, whether that's on an inflation basis, whether that's an employment. I think we got a little bit of an employment scare, and that really was a worry, more so than I think reflation. We have had a couple upticks in inflation, and there is a sort of question of maybe the Fed does need to pause its rate cutting just to make sure we're all good on inflation. But the labor market was the real scare. We saw that in Q3 where we had some pretty bad jobs misses, and now we're going to see some bumpy reports with the hurricanes and whatnot. But the labor market, the jobs market is the lifeblood of the U.S. economy. 70%-ish of U.S. GDP is from consumer spending, and they can't spend without jobs. So that really is the key focus for me. We need to see that continue to be constructive in 2025.
All right, hold that thought. We need to take a short break. Coming up, we're going to be talking market breadth and concentration, and then an emotionally charged who wore better to round things out. This episode is brought to you by the number 245 billion. That is the notional dollar volume of Tesla options that traded the Friday after the election. It's an astonishing figure, which gives us a good excuse to talk about how to get started trading in options. And just give us a little backdrop here. We've seen this explosion in retail interest in options trading, but it still kind of remains elusive for a lot of investors. It's complicated sometimes.
It's complicated. Yeah, that's a great way to sum up options. They are more complex. They are more difficult. Think about when you approach we'll say Tesla, for example, since you led in with it. If you were bullish on Tesla or bearish on it, you have two options. You either buy it or you sell it, or I guess three options. You could have nothing to do with it. But when it comes to options, there's so many different components to it. Even if you had your direction, even if you were bullish and you decided, I want to go with calls, but you could also sell puts. You have to decide, what duration do I want to be involved with this trade? What strike price do I want to choose? So for a retail investor, that's a lot of choices. And if you're not familiar with the terminology, if you're not familiar with how these vehicles trade, then it can be really discouraging and really intimidating to approach them.
So what do you do? If I just decided, I want to try this and experiment today, how do you go about researching or picking a stock that you feel you want to do calls or puts on? How do you do it?
That's a great question. So there's now more than ever, there's more resources online and more information online to figure these things out, to learn. A lot of even brokers, I know we have an academy where investors can go and learn about calls and puts and into all the different terminology and how they work and the mechanics behind it. I think for me, my advice would always be to A, go slow, and to B, if you're not sure, then don't do it. There's always another opportunity to get involved in any stock. And if you're not sure what you're doing, options are very easy to get yourself blindsided in if you are doing something that you shouldn't be doing with them. So,
especially if you're selling instead of buying. But just talk to us about some of the basics here. You can buy or sell an option, and we have calls and puts, and just start there.
Just start there. So if you were bullish, you would buy a call. And if you were bearish, you'd buy a put. So sticking with Tesla, for example, if you're feeling good about it, you think it's going to go up, and before the election, after the election, whatever you want to think about it, you're feeling good about it, you want to buy calls. So then the next thing you would have to decide is what strike and what expiration date.
Strike is the price.
And the strike is the price. So if shares are trading around 320, maybe someone might want to go a little out of the money. Out of the money being that's
Where
kinda
it's
hard to
trading right
explain.
now?
Yeah. Yeah, maybe we
Do a bunch of math calculations.
yeah, it's out of money. So if it's at 320, then the 340, anything above 320 would
We
be
have
out of the money.
definitions that pop up. They save us every time, so we just move on.
This happens with options all the time. You start with one thing and you end up going somewhere else with it. But then you have to decide, how long do I want to be in this trade? I think the big mistake that a lot of retail investors make is they go too close to the expiration. So they would choose something like maybe a 340 call, but they would look at the end of this week or maybe the end of the month, whereas really maybe you should be 2 or 3 months down the road. Give yourself some time for that trade to play out, because one little move in the wrong direction and a short dated call really crush the value of it. So I think that's where a lot of people go wrong is being too short dated.
Do you pin its duration, right? How long do you pin that to like an event? So like Tesla's having an event in 2 months. Is that something that people try and navigate?
Yeah, that's a great
Earnings.
question.
Earnings.
Cybertruck, whatever.
Earnings, the
Optimus.
the We Robot event. Yes, things like that. Even the election with Elon Musk being so involved with everything going on. And a lot of people will try to capture those events with options. And to be honest, they're a great risk management tool. And a lot of retail gets themselves in trouble by trading too big of an options position. They make it too big of their portfolio. And when you go into a binary situation where it's either the outcome is good or bad, that option is either going to explode in value if it's the outcome you wanted, or realistically get crushed and be worthless. And if it makes up too big of your portfolio, that's where you get in trouble. But if you approach it with an option and it's a small little bite of your portfolio, that's where you really have control, because you know what your risk is going to be going into that event. Whereas in common stock, if things don't go your way, you can have large losses. And so that is a really good component to options.
I want to do it so badly, but I know I'll mess it up. No, I know I'll mess it up.
I'll hold your hand.
I
We'll
can't.
do this.
I messed up the first time I invested in a CD. So options, no. There's a lot of math.
There's a good story there.
There's a story there. We're not going to tell it now.
Okay.
It's just too much. So there's so much math here. If you were an average investor and you're picking the strike price, do you have to do some calculation, or can I just say it's at 230, I think it's going to go to 250 and done?
Yeah, to be honest, there's a lot of different ways to do it. For me personally, I'll just give my personal take. I always like to go just a little out of the money. So I keep using Tesla. Maybe I should.
No, that's fine.
Yeah.
I'll stick with Tesla. I mentioned if it was trading at 320, I might go to like the 340s. That is something I would typically do. Something a little out of the money. It's not as sensitive at those prices to fluctuations in the stock price, but it will quickly get to where I want it to go if it moves in the direction I'm looking for. So I always go a little out of the money.
All right, we're going to pivot here. We're going to pivot hard. We recently saw Mike Tyson emerge from just stick with
Hard
me here.
pivot.
We recently saw Iron Mike emerge from quasi-retirement to take on a competitor half his age. Today, we welcome the showdown of the century. In fact, it is draped in caution, yellow, and clutching a treasury bond. It's a trembling titan of timidity. It is fear. And on the other side, decked out in a bespoke Gucci suit, no less, tossing around crypto coins like confetti, the bold baron of ambition, it is greed. So we have fear versus greed here at Whose Word Better. You can't contain yourself.
I can't. It's just so funny. You wrote it really well.
Oh,
too.
thank you. There's the yin and the yang. They're the yin and the yang of market psychology, the frenemies who drive buy and sell. And today we're going to pit them head to head in this following question. Who really wears market returns better? Is it fear's protective instincts that shield us from ruin, or is it greed's hunger for gains that lead us to untold riches?
I'm just loving that pivot. Man, that's a great question. Fear and greed, it's what makes the markets go up and down. It drives the sentiment. It drives the trends. And to be honest, I like the idea of stepping in after fear. Fear has such a great way of washing everything out and driving sentiment down and bringing prices down. And
Sentiment
it comes down so quickly when things get fearful on Wall Street. But that sets up the greatest returns for long-term investors. I think going back to the 40s, there's only been, I believe, 2 instances where the S&Ps declined more than two consecutive years or more. That speaks really, really loud volumes, I think, for the long-term bull, the long-term investor, someone who has patience and can step into those moments where it is fearful, but they're seeing the bigger picture. They're seeing where things can go down the road. And I think that really sets up investors for the long trade.
Do you want to hear my answer? I just
Please.
wrote it down.
Yes.
Greed is not the absence of fear.
Oh,
There
wow.
we go.
That's
There we
heady.
go. I feel like greed has to be the winner to me, because I feel like if you're going to try and be a very successful in the stock market and investing, you kind of
Yeah,
have to
swing a
take
little.
risk. Yeah. I like you know, I think that if you're only investing in the indices, you're growing wealth probably, but are you taking the big step to make a big bet and get big return?
That's
All
fair.
right. You're erring on the side of greed. Or,
And-
I'm sorry, was it
No,
fear?
I'm Aaron Greed. Greed
Okay.
is not the absence of fear.
Gotcha,
You can have both.
Are we done with fear and greed?
We're done with fear and
Oh,
greed.
okay. I want to ask about your first investment here. We're going to get a little bit personal.
Sure.
As I understand, it was Alphabet, the old ticker GOOG. Tell us about that. What got you into stock investing?
Yeah, how I got into stock investing was I took a class actually in high school, and it had one component was building wealth, and we did a mock portfolio on Yahoo.
Nice.
And everyone else, when they were done with the semester, they just, I'm sure they let theirs go. I kept tracking my portfolio, and it was doing really well. I didn't know what I was doing at all, so I said, well, what is this all about? Like, this is a lot of money, and of course it was mock money, but I had a lot of fun with it. I started to view it more as a puzzle, and I really enjoyed it. And I read a lot of books. I took in as much information as I could, and finally I landed on, when I finally got enough money put together to open my brokerage account, Google was the name I landed on. It was Google at the time.
And it might have been expensive at the time. How many years ago was this?
Oh man, I don't know. It was
You're
15
aging
years
him.
ago, maybe.
Okay.
Was
15.
it GOOG or GOOGL? Did I just
Yeah,
get
it
it
was,
right?
it was before they added the second
Okay, so
class.
that's old school Alphabet right there. Before they changed, so that was actually
Yeah.
old school Google.
Google,
because they
yeah, it was
changed
before
it
the
to
name
Alphabet.
changed, before the stock changed. So
What is something that you had, like a concept of investing that you had a difficult time understanding when you were first learning?
And don't say options.
Yeah.
not
I already said that. My
Options
answer.
would have been a mistake to start there. I think the hardest thing for me to wrap my head around coming into the market from an investor, first, being a skeptic. I think skepticism drives a lot of protection type of qualities when you're making decisions, which is a good thing. You don't want to be just firing from the hip, hoping it works. But at the same time, being too skeptical, I think forces you to miss a lot of opportunities. And I know that did for me as well. And looking at things and being like, oh, that's overvalued. But forgetting the fact that it's a great business. Like Amazon's a great example. It had a very high valuation for a number of years. And a lot of people missed that opportunity because the valuation was high. And but it was a phenomenal business. And so I think that can play a role in, maybe keeping investors out of good stocks.
Is it more important to you that the business seems like a good company, or more of the technicals behind some of the stock moves and the
Or
company?
the fundamentals, like,
yeah.
you're looking
Yeah.
for that pop in the growth or, the price.
That's a good question. When I first started investing, I was focused more on the fundamentals, and I didn't have necessarily a great grasp on what I was looking for. I thought I knew what I was looking for, but over time, I added technical components to it and started using charts more and understanding how price action is. Looking at a chart is more of a reflection of the mood of Wall Street or the mood of investors and the sentiment. And I've relied a lot more on the technicals in the last 5 years or so.
30 seconds left. Any final word for investors here?
Biggest advice?
I think cautiously optimistic gets the job done going forward.
2025, here we come. We are winding things down here at Stocks in Translation, so be sure to check out our other episodes on our website or mobile app. We're also on all your favorite podcast platforms. You know them well: YouTube, Apple, Amazon, Spotify, iHeart, and more. That's all for now. Keep your dial tuned to Yahoo Finance.